name is Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your August 2019 market update. Well, there were four key drivers of returns in the month of August. First, it's been more than a year since the start of the U.S.-China trade dispute, and resolution seems no closer at hand. Instead, trade tensions intensified in August. The trade truce reached at the G20 summit was broken at the start of the month when President Trump threatened to slap 10% tariffs on the remaining $300 billion of Chinese imports. And this quickly descended into a tit-for-tat spiral, with the two sides announcing a fresh round of tariff hikes against each other on August 23rd. Near the end of August, President Trump did offer some optimism on continued communications with China, but certainly the tit-for-tat spiral during the month of August caused quite a bit of market volatility. The second key issue in the month of August was that the protests in Hong Kong over proposed legislation allowing the extradition of citizens to China continued and turned increasingly violent. Hong Kong is the financial hub of Asia, and for decades, Hong Kong has used its proximity to mainland China and its special economic status to attract major European banks and other multinational companies. So as the protests turned increasingly violent, the political crisis threatened to become an economic one for Asia, which also led to elevated market volatility in August. Now, just out this morning, Hong Kong leader Carrie Lam announced that she's formally withdrawing the extradition bill, which is a good step forward. However, there are still four key demands of the protesters that have not been met. So we're going to continue to watch developments in Hong Kong closely because the protests are continuing even after the announcement that they are formally withdrawing the extradition bill. The third key issue in the month of August is that Brexit uncertainty continued. As a recap of where we are with the Brexit, the British public voted to leave the European Union well over 3 years ago, and Theresa May, the former prime minister, was not able to get her Brexit deal through, which led to her resignation. So Boris Johnson became the new prime minister in late July, and he vowed to take Britain out of the EU by October 31st, no ifs, ands, or buts. And the political challenges continue on that front as well. So a lot of uncertainty around the Brexit. And lastly, data pointed to slowing growth around the world. In the U.S., factory activity contracted in August for the first time in more than 3 years. And so the economic data, both abroad and in the U.S., continues to show some slowing. So that has also concerned the market. So with this backdrop, not surprisingly, the S&P 500 index, which is what this chart shows, this is a measure of the performance of large cap domestic stocks. This index was largely stuck in a trading range for the month of August, as tweets from President Trump and various news stories led to a fairly volatile month for the stock market. As shown by the yellow bars, the yellow horizontal bars on this chart, the trading range is fairly wide, with every move from bottom to top and then back again representing about a 4% move in the markets. And we've made this move 6 times in 4 weeks, which is fairly remarkable and also quite dangerous for shorter term traders as well, to see this type of swing in the markets over such a short time frame. So overall, the performance in the month of August was negative for domestic large cap and small cap stocks, the yellow and red bars there. Also negative for international and emerging market stocks, the gray bar. They were down by over 3% for the month of August. Commodities also declined on slowing growth. The Barclays Aggregate Bond Index, the blue bar there, that's had a positive month as the steep decline in bond yields continued. The bond index is up 2.59% for the month. And the move in bond yields this year has been quite stunning. What I wanted to show you is that on this chart, this is the performance of the Barclays Aggregate Bond Index over the last 10 years. And right at the end there where you see that yellow line with the strong upward slope, that is how much the Barclays Aggregate Bond Index has moved this year. Through the end of August, this index is up over 9%, which is quite impressive and a bit uncharacteristic for a bond market. As you can see in the past, usually the bond market's more of a steady ascent with some sideways moves, but we've had quite the dramatic run up. And the question then is, well, what is driving this type of move? Well, slowing global growth we just talked about, and the Brexit uncertainty, Hong Kong protests, and the trade war has been leading investors to dial back their risk a bit. And additionally, central banks around the world have been quite accommodative with their interest rate policies, which has caused bond yields to plummet and bond prices move inversely to yield. So as interest rates decline, the price of bonds moves up. What I wanted to show you is where we are right now with bond yields around the world. This chart shows the real yields of government bonds, and the United States is the dark blue, turquoise type color at the very top of the chart. And what this is really showing us is that yields around the world are not keeping pace with anticipated inflation. At their worst, they're outright negative. You can see that investors are buying 10-year government bonds in the UK, which is the light blue line on the bottom of the chart. Investors buying 10-year government bonds in the UK or in Germany, the light green line, are getting a negative real yield. So a bond's real yield is the yield of the bond minus the rate of inflation. So what this does is this measure accounts for the inflation rate and more accurately describes the yield that investors are receiving over time. So investors that are buying these types of bonds in Germany, in the UK, Japan is slightly negative as well, as is Australia, also moves slightly negative. These investors are literally paying to lend money in these markets. And because of this dynamic, even in the US, even though our real yield that you can see at the end of the chart there, the very top line, even with our real yield as low as it actually is, it's still attractive relative to other bonds around the world. And so because of that, that's been driving a lot of assets into US bonds, because even though the yields are so low, especially on a real yield basis, the yields are still higher than what you can get elsewhere. And so this has caused a large influx into US bonds and quite a large price increase this year for investors in this market. And there's actually some speculation now that rates in the US may eventually go negative, which is obviously at an interesting juncture then for investors, and some decisions need to be made there. So the question then becomes, given this backdrop of slowing growth, Brexit uncertainty, trade uncertainty, and negative yields for many bonds around the world, how are we positioned? Well, first, we're not really ready to declare that a recession is imminent, but we do expect economic data to remain weak, especially while we have so much uncertainty around trade and the Brexit. Many economies outside the US are struggling, as witnessed by those negative interest rates in Europe and Japan, and poor economic data out of Germany and China. So we're watching that closely. However, there's other indicators in the US market, such as the jobs market, which is still showing very robust signs that our economy is still on good footing. So we will continue to watch all the different measures surrounding recessions carefully and make changes to the portfolio if warranted. But that being said, we have turned a bit more cautious on our outlook than in previous months, and we have started to dial back some of the risk in our portfolios over the last few weeks, specifically by adding an allocation to alternative investments, which seek to earn returns that are uncorrelated with bond and stock markets. So what you have here is when the stock market as a whole tends to get more volatile when you approach the latter stages of the business cycle, and alternative investments can provide ballast to portfolios in the midst of market volatility. And so because of that, we have started adding some of those alternative type investments into the portfolios in order to get returns that aren't directly related to moves in the stock market or in the bond market. So we thank you for your continued confidence, and please reach out to us with any questions you may have.